It's a worry for these markets because they're down now at session lows, down additional 300 points right now. It's over 1,100 points, I believe, in the last 3 trading days since the big 1,000-point sell-off we had on Friday. That was started by the notion that the Federal Reserve is going to keep raising rates here. There'll be no pivot, no accommodation made. Michelle Snyder right now, the Market Gauge Group Managing Director. Michelle, I don't think the markets like that message and still don't like it. What do you make of this market reaction?
Well, it certainly does give us a dose of reality, considering the rally that we saw from the June lows up to the August highs was based on some kind of A, hopefulness that there would be a pivot based on some recessionary numbers that were coming out, and B, just good old technical oversold conditions. And then I would say C, retail investors really still used to buying the dip. So what's going to happen here right now is going to be interesting, Neil, because we have to see how these 50-day moving averages in all of the indices hold up. They're slightly below, although the small caps are still holding them, SPY's below, and the NASDAQ is below. But that doesn't necessarily mean anything because it's an area. It's not a line in the sand. So if today's selling dries up a little bit as we're heading into a long weekend, we may see a little bit more buying coming in. But I think what we have to remember is we are range bound. And I know the recession discussion is going on and on and on, but I'm still sticking with stagflation, which is very typical of having trading ranges and not necessarily a major crash and certainly not a major rally.
So, Michelle, in the meantime here, we do have U.S. jobs openings rising by another million, 11.2 million. That speaks of underlying job strength there. Consumer confidence, not what it was, but better than what we thought it would be. A 10-year yield that's in and out of a 2-month high, obviously seemingly indicating a pretty robust economy, one that has to be clamped down, I guess. But home prices still running at an 18% year-over-year clip, and people are saying, well, it wasn't the 20.5% clip we saw in the month before. Robust all across the board, though. So I don't see the stag part of that.
Well, certainly that would make the case for not a recession. When I say stagflation, these numbers that we're seeing right now, the question is going to be, can they sustain? And really that's going to be the key. And of course, I heard Mr. Laffer talking about inflation, and we still very much believe that inflation is not going away anytime soon, which could then in turn affect the labor market, could in turn affect the housing market, and of course the consumer confidence. So right now, that's why we're really focused on the retail sector, we're focused on the transportation sector, and we're also focused on the small caps because those are what Druckenmiller calls the inside of the market, if you will. And all of those are just hanging on to this sort of support, or about 50% from where we saw the lows to the highs. And so it really remains to be seen in terms of whether we can grow from here or not. But I think we're just going to more stagnate.
All right. Well, watch closely, Michelle. I appreciate it. Michelle Snyder, the Market Gauge Group Managing Director. Maybe to Michelle's point, some signs out of Toyota of that the stag part of that is on. The slowdown is on.